The vaults are empty, or at least the deliverable ones that matter are on the brink. Monday morning, when COMEX opens, the silver market could face the kind of supply shock that paper traders have laughed off for years. Imagine waking up to find the price you thought was real was just a fiction propped up by promises while the actual metal vanished east. That is not hyperbole. That is what the data screams right now. Most people still believe silver trades like any other commodity. Supply and demand balanced on screens in New York, prices discovered fairly. But what if the system is rigged to hide the real squeeze until it is too late? What if Chinese demand is quietly draining Western vaults while futures prices get smashed to keep the illusion alive? You have felt it already. Groceries up, gas up, savings losing value. Yet silver, the metal that powers solar panels, electronics, and real industry, supposedly sits cheap, until it does not. The question hanging over every investor this weekend is simple. When China reopens trading and the premium explodes again, will COMEX have enough physical silver to deliver? Or will the paper game finally crack wide open? Stick around because the numbers do not lie and they point to one direction: higher, much higher, fast. The financial establishment wants you to dismiss precious metals as relics, gold for crazy preppers, silver for hobbyists. They push stocks, bonds, crypto, anything paper or digital. Why? Because those assets stay inside the system they control. Precious metals do not. You hold them, you own them. No counterparty risk, no bail-ins, no freezes. That terrifies central banks and bullion banks who lease and rehypothecate the same bars dozens of times. They need silver priced low to keep industrial users happy and paper derivatives profitable. So they flood futures markets with shorts, suppress spot, keep the narrative that there is plenty of supply. But the hidden truth is uglier. Physical metal flows where demand is real, and right now that flow points straight to Shanghai. China consumes more silver than the rest of the world combined for solar, batteries, 5 grams, EVs. Their industrial appetite never sleeps. When local supply tightens, they bid up, hard. That creates a premium over Western prices. A premium that signals physical tightness before futures catch up. This is not theory. It is observable fact. Repeated across cycles. When the gap widens beyond normal structural costs like China's 13% VAT and import hurdles, it means real metal is moving east, fast. Western vaults bleed to fill the gap until they cannot. That moment feels close. Let us get into the data, because claims without sources are noise. COMEX registered silver, the stuff actually available for delivery, sat at 81,733,733.319 troy ounces as of March 5, 2026. That is down sharply. Eligible stocks, which can convert but take time, totaled 267,412,161.435 ounces, total around 349 million ounces. Sounds like a lot until you see delivery pressure. March 2026 contract saw 10,526. Notices on first notice day alone, that is over 52 million ounces demanded, more than 60% of registered at recent levels. In prior months, February delivered over 25 million ounces, highest in modern history for the period. Total recent deliveries across months hit 74 million plus ounces against shrinking. Registered, the math does not work forever. Meanwhile, Shanghai Gold Exchange and Shanghai Futures Exchange inventories have declined hard. Schiff warehouse stocks hovered around 255 tons mid-March, down week over week, near decade lows from peaks over 3,000 tons years back. That is roughly 8 million ounces. Tiny compared to demand. See? Benchmark prices show silver trading elevated. On March 6, 2026, related fixes and reports implied premiums persisting. Sources like CME quotes show COMEX March 2026 settling near $83.50 per ounce Friday close, with intraday moves higher Sunday signals. But Eastern physical equivalents, adjusted for conversion, have printed in the 90s and occasionally higher in recent prints, creating gaps of $7 to $10 or more at peaks. That premium is the siren. It incentivizes import, but imports take time. Quotas, logistics, geopolitical snags slow it. So the drain continues quietly until inventories hit critical. Historical precedent backs this. 2021 squeeze started with similar inventory draws and positioning spikes. Deficits since 2021 per World Silver Survey reports forced above-ground stock releases. But those buffers shrink. Industrial demand accelerates with green energy mandates. Silver added to us critical. Minerals list late 2025. That is not coincidence. It is recognition of structural shortage. Now the Steelman counter-argument, fairly, fully. The premium is mostly structural. China's VAT at 13% plus licensing, insurance, freight create a persistent 10 to 15% floor. Premiums stay elevated without global crisis. COMEX eligible stocks can convert to registered in days if needed. No default history. Above ground stocks still buffer deficits. Speculative longs not at extreme levels compared to past. Localized Chinese demand for solar and electronics explains the pull, not worldwide depletion. Tariffs or policy shifts could rebalance without shock. Western paper markets efficiently price global supply. The drain is overhyped noise. Fair enough, but the data dismantles it. Registered stocks plunging below 100 million recently, now 81 million after withdrawals. Delivery notices already exceed half registered in March cycle. SHIFE and C vaults at multi-year lows despite premiums. Global deficits ongoing per verifiable surveys. Premiums spiking beyond. Structural when demand surges, as seen late 2025 into 2026. Conversions from eligible slow under stress. History shows it. Paper efficiency fails when physical cannot arrive. The counter relies on infinite buffer and fast arbitrage. But vaults are finite. Arbitrage is blocked. The East pays up because it must have metal now. The West pretends it has plenty. One side wins. If you are still watching paper tickers while physical disappears, you are on the wrong side of history. That is the viewer bridge. You now see the mismatch most miss. So what do you do? First, buy physical silver only, bars or coins from reputable dealers like APMEX, JM Bullion, or local with good audits. Avoid paper ETFs or futures unless hedging short-term. Premiums over spot run 5 to 10% now for physical. Pay it. Availability trumps cheap paper promises. Second, dollar cost average aggressively. Buy fixed dollar amounts weekly or monthly. Ignore short-term dips. Industrial demand underpins long-term. Third, store safely. Home safe for small amounts. Private vault or depository for larger. Never bank safe deposit boxes. Access can freeze. Fourth, track premiums yourself. Compare COMEX close to C or SHIFE benchmarks via public reports. When gaps widen, it signals entry urgency. Challenge your assumptions. Fiat promises infinite growth, but currencies devalue. Silver preserves purchasing power across centuries. Look at families who stacked through crises, or nations like India hoarding through inflation. They thrive when systems crack. You can too. The thesis lands hard. The vaults feeding COMEX are draining fast. Eastern demand pulls relentlessly. Monday could ignite the squeeze Western paper cannot contain. Stop waiting for permission. Buy physical silver now. Stack it. Hold it. Because when the music stops, only real metal will matter. What are you waiting for? The price to double first. Or the empty vault announcement. Act before the window slams shut. Your wealth depends on it.